All right. Today is Monday, February 10th. This is a recap of the stock market activities today. Now, folks, I got a good one for you tonight. Now that the Super Bowl is over, I hope most of you have sobered up and you're ready to go to the next most important show in the nation. Of course, when we talk about excess, ladies and gentlemen, listen to this headline right here. Degenerate gambling Americans spend over $1.4 billion on the Super Bowl. And of course, most of these bets were in the Chiefs, aka the Swifties, and they lost. Matter of fact, there were bets on Taylor Swift. I'm not even sure. This is so dumb. I don't want to even entertain what this is all about. But folks bet on anything right now. It's a degenerate gambling nation. And you see that evident, of course, in the stock market. The zero DTEs, the lack of regard of valuations, of technicals, of anything really. All what people want is somebody on Twitter or somebody on Reddit or social media or Snapchat or TikTok. Hey, today we're buying these calls and these puts right here. Make you a millionaire. What do you think that represents really? A healthy, growing economy with no excess, with no bubble-like behavior? Think again, buddy. Anyhow, for a moment we thought the Chiefs can make a comeback, and they kind of did, but it was short-lived and more chaotic than Kanye West's comeback. Oh boy. But folks, let's forget about football and talk about the stock market, because if you look at the stock market's chart, we've now opened a larger gap than the age gap between Bill Belichick and his hooker. And the question now becomes, when do we close the gaps? In this case, of course, when he dies. Suddenly, maybe. Under tragic circumstances, the guy fell off his yacht and left all of his money to his new girlfriend. Nobody saw that coming. But anyways, before we talk about the stock market and the gaps, let's talk about some of the macro events that we have and the developments that we got regarding the economy and, most importantly, the trade war. Over the weekend, we got more retaliation from China, now on about $14 billion worth of U.S. goods. And in response, of course, the United States, over the weekend, now imposed 25% tariffs on steel and aluminum imports, of course impacting China the most. The Trump administration wants to hit China really hard, and now they're thinking about tariffs on even prescription drugs coming out of China, which means all of the generics that you guys and gals get for your whatever diseases you got and conditions and illusions. Well, that's going to cost you more now, which is inflationary. And there are warnings that don't do it because this is going to have impacts. You're trying to cut the cost in the health department and Medicare and all of that, but without the generics, if we buy from the big pharmaceutical companies that we have, then whatever mediocre cuts that Doge is doing right now will be replaced and then some. In any case, all of this trade war policies are being viewed as inflationary. You can see here the view on receleration of inflation, global inflation receleration. I want you to look at the black row. That's for Jan 2025. You can see a huge jump. You look at the blue column or blue row here, the November 24 before the elections, and then you see the contrast with Jan 25. It's absolutely huge. What's also important is when you look at global growth receleration, look at the contrast that we have, let's say, October 2024 versus the black row, which is Jan 2025, huge drop. So we're betting right now on higher inflation and lower growth. The combination of both is, say it with me again, stagflation. And it kind of affirms what the Bank of England said last week. And this is going to be, you got to understand that there's a lot of psychology involved here. If we expect higher inflation, we'll get it. If we expect higher growth, we'll get it because it changes the behavior from the consumer side, from the employer side. More on that in a minute, but you look again across the board, folks, whether we look at the 2-year inflation swap in the US, in the European Union, Japan, all of them are moving higher specifically after the elections. Why? Because we have the risk of tariffs and trade wars, which is inflationary. The tougher or more serious the trade war, the more inflationary it is. And the evidence, of course, is what we got today in the commodities market when we've seen the tariffs on steel and aluminum. You've seen the prices of those commodities going higher. Now, the problem for the economy, for the Fed, for the market is the following. This is what we got on Friday, by the way, and caused the flush that we got in the market right away at the moment the news came out. The headline reads, inflation expectations popped to the highest level in a year. And look at Jay Powell with the shocked face. Was that just transitory, the drop in inflation? Yes, it was. And you see right here, 1 year inflation expectations jumping significantly higher. Now 4.3%. That's way above the Federal Reserve target. And then you have 5 years also moving higher. Now, could it be exacerbated a little bit? Of course, because we have tariff expectations. And folks, when they hear tariffs, they expect higher inflation. Then maybe when the policies are clearer, and maybe we find out that the bark is tougher than the bite, those inflation expectations cool off, even though we explained in details before that the tariff policy is part of the dogma of the new administration, Trumponomics. They're not going to let it go. They believe that we should tax the population less, and we should rely on tariffs for government revenue. And a lot of folks agree with that. I agree with it to a certain extent, but I know that the impact of tariffs and the combination of lower taxes is inflationary. You can't have your cake and eat it. You can't have your cake and eat it too. And we also have really interesting finding here from the Consumer Sentiment Index that we got on Friday. You can see here that consumer sentiment dropped dramatically since the elections among Democrats. You can see that in blue. Independents the same way, but of course, just a little tick down. But all of a sudden, consumer sentiment in Republicans jumped significantly higher. And look, this country, of course, is partisan, and we have this mentality that we got, that everybody just sticks to their team, and they have no morals, no values, nothing really of concrete values. Just you criticize the other administration, then when your team gets in, you forget about all of what you claimed as values, principles, and morals, really. But your boy right here, I don't give a flying fuck. I'm going to stick to my morals, my values, what I see right or wrong. Doesn't matter which administration it is, I'll call you out. And of course, at the risk of alienating some of you babies. And this kind of jump is hypocritical because really now the economy got fixed. All of a sudden, all of the problems that we've been talking about, all of a sudden just got fixed because we have a new administration. Maybe there's a little bit of optimism that the new policies could change the trajectory of the economy and consumer sentiment and inflation and all of that. So there's a little bit of excitement. That's understandable. But let's see down the line. Are they going to change their minds and come back to reality or not? With this data that we got so far, folks, the tariff news and inflation expectations going higher, watch what happened here for the expectations of the June meeting by the Federal Reserve. Right now, the odds of keeping rates as is higher than the odds of cutting rates by 25 basis points. So now we're not going to get the May cuts. We're not going to get the June cuts. What happens after that? What do we get? Do we get September? What do we get? Jackson Hole? What if we get a hotter CPI this week? What if we get to the conclusion that we're not going to have rate cuts this year? And the hotter the data becomes, the odds of rate hikes begin to creep in the conversation. What if that begins to happen? You'll see, of course, the market reflecting that ahead of time. So keep that in mind. Now, also on Friday, we got the jobs numbers, and what's important is wages versus inflation. So you see that wages are beginning to creep higher again. And of course, in time, that leads to higher inflation. So that's your inflation risk, which we talked about the duality of the risk, the walking the tightrope and the wind and all of these analogies that we talked about last year. Now, with the inflation risk creeping back in, that's going to limit the Federal Reserve's ability to cut rates and have a stimulative or at least an easy policy, which the market was betting on. And that is evident, of course, by the pause that they've done in the last meeting. We know that the steps are you cut, you pause, then you hike. You hike, you pause, then you cut. So this is not heading toward a, let's say, favorable outcome to anybody betting and gambling that this year is going to be as good as 24 and 23. At the same time, with the inflation risk increasing, guess what's also increasing? The recession risk. Now, the jobs number, you got huge revisions for the month of December, for example, positive revisions this time around. So we're not there yet. The recession risk is not that big. It is creeping in. It is impacting certain segments of the consumer. But so long as we have a hotter stock market that is right now being inflated via the bubbles that we see in AI, so long as we have that, you're not going to see acceleration of the unemployment rate and companies firing folks because stock market is high, everybody feels good, they're spending more, and companies need their employees. But notice that when the stock of any companies goes down, let's say 20-30%, you begin to hear headlines about layoffs. So when folks say the stock market is divorced from the economy, forget about it. It's not even true, not even close. The stock market is the economy. Without the stock market right now, we would be in a deep recession. Keep that in mind. So the moment the bubble pops, you're going to see the unemployment rate surging significantly higher. But right now, the risk of recession is tamed, but we're beginning to see warning signs. So you see, for example, in the latest report for the month of January, Education and health remains the hottest sector, but the pace of job creation is slowing down. Retail, of course, that is seasonal because of the Christmas holidays, so we're not going to put a lot of weight on this number that we got for the latest reading. Government jobs remain hot, but we know that the Trump administration wants to tackle that. So eliminate retail and government. Okay, you got education and health creating about 61,000 jobs, but the rest of the economy is weak. Business services, we lost 11,000 jobs. Leisure and hospitality, which is supposed to be hot, lost 3,000 jobs. Not a good sign for the economy. And then you got also what we see with AI right now. Why do you think they're making AI? Just to make your life better? Of course not. Sex robots, unemployment, and nuclear annihilation. These are the three main objectives from AI. So right now we see IT unemployment, for example, rising to 5.7% as AI hits tech jobs. All of these genius nerds, the software engineers are like, oh, AI is going to help me out. You don't understand, Maverick. AI can code software for you. Yeah, dummy. It's going to take your job. And this is what we see right now. Software developers not wanted. The pace of job creation year over year change of job postings on Indeed.com negative. Still negative. It's been negative since 22 and still negative. The only engineers they want to hire are the engineers who are going to continue to code the AI and then shoot them out once the AI is ready to do their jobs for them. So folks don't understand that the development of AI will lead to higher unemployment rate. And when you have the dynamic of tariffs, when you have the dynamic of a lower dollar, for example, because we're going to have to do that at some point. We're going to have to devalue the dollar to tackle the national debt. And when you have unemployment by AI, you're going to have to pay folks more. You're going to have more social assistance, whether you like it or not. The combination of all of that is we're about to head, folks, to a major stagflationary period in the economy. That's the truth, whether you like it or not. And the result of that in the market, of course, we'll get a crash, then we're going to have a lost decade or so. What goes up must come down. And we've been in this fantasy, we're living this fantasy land since the last recession, based on the sugar high. How many years it's been right now? 15 years, 16 years? You really think that's going to last forever without what goes up must come down? Without the drop? And the longer the high, the longer the recovery, and the longer the hangover. Keep that in mind. Let's talk about markets a little bit because today I gave you a morning brief. And sometimes when I give you the morning brief, it's just trying to get your mindset in the right direction so you can look at the charts and look at the dynamics and make your own decisions. So today we talked about a few things. Number one, we said there are rumors that China is readying another stimulus package, which is causing Chinese stocks and will also cause related commodities stocks to rise. Stay long China and rent some of those commodities stocks, especially materials. We're talking about steel, we're talking about aluminum, we're talking about some of the agricultural stuff. Number two, steel tariffs are causing inflation concerns to rise. So we see the Dixie and bond yields slightly up. The combination of tariffs and China stimulus can lead to days where the dollar, commodities, and Chinese stocks to move up together. And today you've seen that phenomenon. Dollar up, Chinese stocks up, commodities up. And you can see that dynamic lasting for a little while. Number three, the VIX is forming a bull flag and readying to move up. Its stock market indices are also higher because of optimism that spending by big cap companies should lead to a recovery in NVDA stock. The reversal of the DeepSeek narrative, at least that's what they're trying to do right now. Or DeepSeek told us that they're not going to spend because we can do AI cheaper and better. But the companies are still planning to spend. So you see that convenient excuse to go back and pump the flows into buying the dip in NVIDIA. Now, I told you that I disagree with this assessment because the majority of the spending by these AI companies, we're talking about the big guys, Google, Microsoft, Meta, etc. They're spending on developing in-house chips, not the ones they're buying from NVIDIA. Number two, of course, their stocks will begin to suffer because the numbers are not just going to add up. CapEx goes higher and then net income slows down. The stock is not going to do pretty good. So at some point, they'll get the memo. After the stocks are down 10, 20%, they're going to say, okay, you know what, we got it. Message received. Let's reduce the CapEx, and that's going to be negative for NVIDIA. But for now, it's a convenient excuse to pump the flows back into NVIDIA stock. Has the highest weight, of course, in the indices, so the combination could lead to a day where the VIX and the indices trade higher together. However, I will take the opportunity to hedge my portfolio and add to some short positions on the indices and big cap companies. So today the VIX was down, but it wasn't down by much. The indices were higher based pretty much on NVIDIA and some rebounds in that way of thinking that, hey, maybe we've overreacted to DeepSeek. I disagree. I think that the reaction was proper. But right now, there is a convenient excuse to try, keyword try, to reverse that narrative. We'll see how long it's going to last or not. But let's revisit the morning brief that we've done on Friday because we haven't gotten a chance to do that. Of course, we talked about the fact that the VIX in 2018 Instead of crush the VIX Fridays, we had buy the VIX Fridays. And we could see that phenomenon. Indeed, we've seen the VIX going higher Friday and the indices flushing down. We talked about certain charts too. We talked about MCD McDonald's. We talked about this chart that I gave you that we have an inverse head and shoulder. Today, the named reports earnings, and there we go. Nice gap higher. Mickey D's all of a sudden making a comeback. And the assumption right now as we close the gap, this is a classic kind of stock. It ain't going to leave a gap like this open. We close the gap, trade is over, we'll do something else with the money. And the bearish chart that I gave you was for ET Energy Transfer. A lot of you love this name because of the high dividend. It's been catching a tailwind because of all this data center hype. But I gave you this chart that maybe we're seeing a bear flag pattern and we're having a deterioration in the momentum looking at the MACD and the RSI. And here's the update. We went down a little bit, but we have a report coming. Now, if you do like the name, you like the dividend, you like the story of maybe data centers that will still have to spend on energy, then that's okay. But I'd love to see a dip. I'd love to see a significant pullback after the report comes out. And then we're going to reassess if it's just a case of the bar went way too high, but the report is good. We'll buy the dip in ET. Then lastly, in the morning brief on Friday, we talked about Uber. We said that I'm also looking into getting into Uber calls today with February 21st expiration, eyeing the 70-75 call spread. Of course, this is already in the money, so the trade is over. And you saw Uber jumping significantly higher on Friday's session and then again today. Why? Because we have Snake Bill Ackman buying the stock. Now, for a trading perspective, sure, let's follow that because the algorithms will hear, oh, Bill Ackman is buying, let's buy the stock. So it's going to go higher, and it did already. Of course, what Snake Bill Ackman is doing, he knows that once the news come out, the stock will pop higher. So his firm is buying call options beforehand. And when the stock pops higher, they dump these call options, and they make money that way. Whether the investment thesis is right or wrong, it doesn't matter. They already made money up front by the algorithms chasing the news. So keep that in mind. This kind of corruption and crimes, they get away with it, of course, because that's the legal way to do crimes in this country and cheat. You can cheat, but you got to do it the American way, the legal way. And nobody knows how to do that better than Snake Bill Ackman. Now, we're going to give you an earnings review video. Let's hope for today. I'm almost done with it. It's just a short video. It's not a big video reader, so I can finish it tonight. It comes after this video. We're going to do Apple because there's an important point to keep in Apple and there's an important point to keep in Uber. Is it really worth buying? Is Bill Ackman seeing something we're not, or is he just trying to pump and dump? We'll cover all of that in the upcoming video, but let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices, and here we go. The diamonds up slightly. This is, of course, dependent on bond yields going down, and they didn't go down by a lot. They were actually a tick higher. In any case, the diamonds up in the green by 167.01 points, or a gain of 0.38%. The Nasdaq, thank you to NVDA, is the leader today, up by 190.87 points, or a gain of 0.98%. The S&P also positive, 40.45 points, or a gain of 0.67%. The Russell 2000 wasn't doing pretty good in the morning, but it was a low volume kind of day, no macro news, good excuse to just buy the dips randomly and see what happens in tomorrow's session as we begin to get macro. And we see what happens with the CPI, so it managed to close positive. 1.02 points, or a gain of 0.45%. Looking at the sectors, what do we see here? Pretty much most of them are positive, led by energy. So today we've seen crude oil moving higher based on the tariff news, based on the China stimulus news, most importantly. So we see energy moving higher, technology at number 2 because of NVIDIA, metals because of the tariffs on steel and aluminum. At the bottom of the pack, financials and healthcare. Why are financials down today? I think that the managers used financials as a resource of safety, or a resort of safety, I should say. And now that they need to free up some capital to chase NVIDIA again, they're dumping the banks and they're moving to the chips once again. Whether that's going to be proven right or wrong, that remains to be seen. Looking at the breadth, NYSE 56% advancing, 42% declining. The Nasdaq 49% advancing, 48% declining. So the breadth was not good in the Nasdaq, even though it is the leader of the day. Why? Because of the heat map. And we begin here, of course, with the revival of the data center theme. And that, of course, includes NVIDIA, AVGO. You got some empathy bets that are coming out to AMD, Qualcomm, Micron. But I would say that the two biggest benefactors would be NVIDIA and AVGO. And of course, you have the equipment makers like AMAT, ASML. Those are always going to go higher. When we have a revival of the data center bet. Dell, all of these server units will also move higher. And of course, the energy demand that comes in Constellation Energy, Vernova, and utilities. And you see it here in electricity and VRT. Not to mention, of course, when we talk about AI and data center, the theme of the data center revival, that includes some natural gas, some energy plays. So you have a double tailwind today for energy names, including the China stimulus news and the revival of the AI data center bets. So we see a lot of nat gas plays moving higher today. Coterra, EQT, all gaining over 4% in a day. And another AI play, of course, is Eaton. So a lot of industrials here are also included in that theme. Carrier, you see that name is higher. GCI, or JCI rather. All of these names are included in the AI data center bet. And you'll see also Caterpillar, if this theme continues, you see even Caterpillar beginning to catch a bid. Ferguson is included in those. So today it's clear that we have a rotation back to the data center theme. Where's the money coming from, by the way? The money's coming from these guys right here, financials. We don't need to park the money in JP Morgan anymore. We need to move the money to the data center theme. You see it coming from some of the healthcare names that went higher recently. They're taking some of that money back in the data center theme. But besides that, folks, when you look at the China theme, you can see that evident in Alibaba, JD, the AI narrative in China. That's the one that's catching a bid. Not so hot so for the Chinese EV makers, but I mean, NIO's up 2%. You have XPV down, but it's been hot. So it's just pulling back for a little bit. I think some of the flows will rotate to NIO. That will be the opportunity. When we talk about technology, of course, cybersecurity remains hot. But we see today a revival in also software. So you see Adobe, Oracle going higher. Palantir because of the options market, but you see software coming back. Looked a little shaky on Friday's session that we might head down to the market. So we were on the safe side in removing the bets on Datadog and Snowflake. But you see them higher today, so if you want to put that back in, you justified. Just remember that we have earnings coming out for Datadog really soon. But even Trade Desk is up about 4.5% today. Sometimes you got to be patient. When you believe in a theme, when you're betting on something that you did your homework on, it doesn't work out right away. You got to be a little patient and give it the time. Of course, Uber, because of Snake Bill Ackman, we see Uber continuing to add to the gains. Another important theme that we see today is coming in the weakness that we see in airliners. Why are the airliners down today? You can argue that, okay, energy is going higher. That means that the prices of jet fuel will go higher. Got it. But you see also weakness here showing up in the cruises. You see Carnival Cruises down, Norwegian down. What's up with that? Because we see also the hotels a little weaker today. I think that the jobs data, with the fact that we lost jobs in the leisure and hospitality sectors of the economy, is maybe seen as a warning sign that consumer spending is slowing down. And we know that the affluent consumer is spending more and more on leisure and hospitality. So if we see a reduction in jobs, maybe that spending is being taken off a little bit. As investors and the affluent consumer who relies on higher stock market becomes a little more careful about spending. Maybe that's also tying up with what we see here in AXP. That's a pulse on the affluent consumer. And if AXP is down along with the travel names, put two and two together, and you see the theme that we're talking about here. That maybe the market is a little afraid about the jobs number that we got on Friday. Of course, when we talk about China theme, don't forget about Nike. It was awful in the morning, but then the market realized, okay, Nike may be a part of the China theme. Estee Lauder catching a bid, oversold, but also part of the China theme. So keep that in mind that the China theme is not just the pure Chinese names, but it also comes with Nike, Estee Lauder, and some of the names you see here in defensives, like Philip Morris, for example, that also has a China exposure. Not the gambling stuff, though. Las Vegas Sands down, went down. So with the stimulus news, I'm thinking about maybe there's an opportunity there. But I got to see some buying showing up before I do. I don't want to be the donkey who's jumping in first. I got to see some other folks jumping in, and then I'm going to follow. Looking at the heat map for the ETFs, the TLT is down a tick, so we're not seeing yields going up by much. So the market said, you know what, we'll be muted here in the risk-on segments like the IWM. Will be muted, slightly positive in some of the risk-off stuff like XLU, but that's coming on the backs of Veranova and CEG, the AI data center theme. The rest of the yield-sensitive stuff is muted. You can see it, of course, evident by the Dow Jones being muted, the RSP being muted, the value stuff, the mid-caps all muted. But we see, because of the XLF and the money being freed out of financials, we see the KRE down, we see the XBI down. Of course, we talked about the energy theme, double tailwinds today, coming from the revival of the data center theme and China stimulus. So we see energy going higher, led by the XOP. XOP will give you more gas exposure than the XLE. Of course, when we talk about China stimulus, the Chinese names, YINN, FXI, all doing pretty good. Pick your pick. And then we have the dollar higher, but with the risks that we see and the inflation threat from the tariffs and the China stimulus, we see commodities doing pretty good. Gold miners are up today, but you got to be careful. I would hedge via SLV puts or GDX puts, GLD puts. Doesn't matter which one you use. I would hedge weekly and stay long gold and silver in the long run. But you see nat gas here, BOIL moving higher, UNG moving higher. The commodity oil, USO going higher. So we see commodities doing pretty good today despite the dollar going higher. We talked about that in the morning brief before the action even began. Let's do some commodities here, beginning with energy. Look at this nice day today in crude rebound. We need to see a little more of that. If you're investing in energy or you're just buying crude, USO right now, I think it's pretty much bottomed, ready to go higher. Brent also up about 2%. Nat gas, the party boy, up about 4%. All of this is, of course, coming from, most importantly, the China stimulus news. If you have China stimulus and then, because China stimulus leads to higher demand, you can counter that and say, oh, but the Trump administration is going to increase supply. Here's the problem, though. I want you to read this article right here from Fortune magazine. It reads, Trump vows to tap America's liquid gold, oil reserves, and drill, baby, drill. The only problem is, it's not up to him. Right? The oil companies are not going to shoot themselves in the foot. Mr. President, kindly, you can go fuck yourself. Why would we drill more and lower the price of oil and hurt our revenues, net incomes, and all that stuff? The oil companies right now are returning value to shareholder more and better than any other sector in the market in terms of dividends and buybacks and all of that. And they'd love to do that more. So they're not going to hurt themselves. That's number one. Number two, to drill, baby, drill. You need to remove a lot of regulations. It takes a lot of time. It takes a lot of investment. By the time we actually manage to increase the production, let's say by 2 to 3%, that's going to be a huge increase. His term will be over already. 4 years will be over. So you got to keep that in perspective that right now the traders are reactive. When we get any news or Trump comes out and says, oh, we're going to drill, baby, drill. We're going to unleash the wealth of this country like the likes that everybody's seen before. We see the traders immediately reacting and shorting oil and selling oil. But at the end of the day, the fundamentals are clear. If you get China stimulus, that's going to increase the demand. And if you don't get an increase from supply, oil prices are going higher. And that's going to be inflationary. The only way you can increase the supply is Saudi Arabia to increase the production or the Iranian oil, Venezuelan oil. Can you do that? Can you really be lean on Iran and allow them to pump more barrels in the market? About Russia? So there are a lot of problems here in the assumption that oil is just going to go down because, oh, the president is barking. When we look at metals, what do we see here? Gold, best asset to be. Safety works with the dollar up, dollar down right now because everybody's saying, you know what? With all of this uncertainty and tariffs and all of that, I'm just going to park some money in gold. At some point, it's going to pull back, okay? At some point, it's going to pull back big. But right now, I told you about this with the asset managers. They're diversifying portfolios to the equal weight in gold. A lot of demand in gold. So we see gold higher today, silver to a certain extent, copper. With the tariffs, we see the dollar, even though higher, but because of the tariffs and the China stimulus, of course, copper is really sensitive to China stimulus. So it's up about a little over 2.25%. Looking at some softs and grains, we see grains muted for the most part, but softs, OJ continues to come back, down about 4.5%, but coffee, hot, hot, hot. No stop inside here, folks. We made a short video on it, on the call that we made in coffee last year. Commodities are easy to predict because it's supply and demand dynamic. And if you can spot that ahead of time, you can score big in commodities. And today we see coffee up almost 5% in a single day. Moving on to the big casino options, what do we see here? The volume is down today. We're still trying to sober up from the Super Bowl, so the volume is a little bit down. I didn't even watch the thing. My wife watched it for Taylor Swift, and the moment it was clear that they're going to lose, she shut the TV off and went upstairs. So anyways, when we look here at the volume down across the board, but looking at the call to put ratio, we see that the majority is still buying calls. Some excess showing up in Alibaba with 81% calls, but that's a product of the stimulus news. If I see 81% calls, 85% calls, and then I see the IV rank at the 90s, yeah, I'll be worried. I'd say, okay, it's time for a pullback. So a lot of you said, hey, Mav, do I short Alibaba? Why would you do that? Follow the momentum right now. China is hot, hot, hot. Keep following that theme. And then we see, of course, excessive buying in Uber. But again, the IV rank is about 23, so we don't see a lot of risk over there. Majority of the IV ranks, to be honest with you, are muted, so the option premiums are still reasonable right now. I see certain trends, though. I see the demand for puts increasing in Tesla, which is leading the stock down. Of course, Elon is a disaster, and he's a lot of investors just don't want to associate with him. A lot of investors, especially the big guys, will say, okay, the stock is up. This guy is losing his mind. Again, whether you agree, disagree, that doesn't matter. But they see him as a risk. He's volatile. He could say anything at any point. He can become Kanye all of a sudden. So there's a lot of risk here, and we see folks dumping Tesla and buying some puts. You see the same phenomenon in Palantir. We see increasing demand for puts, but here's why the stock is not going down. because the majority of these puts are being bought for longer expiration dates. We're talking about the back end of the year or even 26. They're betting that Palantir is going to crash and go down. But the market maker right now follows the feedback that they see most immediate. And if you look at the options chain for this week's expiration, for example, in the options, the volume for calls is almost 4-to-1 to the volume of puts. So if nobody's buying puts, the market maker says, okay, the guys who are trading options, they want to squeeze it higher. So I got no other option but to keep buying the stock and moving it higher because they bought the 110 Friday or last week. Now they're buying the 115. Now they're stamping to the 120, and they keep rolling and rolling and rolling. Now, you might say, okay, Mav, how long does this game last? Can you just pump the stock indefinitely? The answer is no, because at some point it becomes the market maker bought a huge quantity and now wants to exercise maximum pain with the majority of the calls that got accumulated. Are we at that point right now? Remains to be seen. We need to see higher volume. We need to see Palantir in the millions, and then that phenomenon will take place. Let's do the unusual activities here, folks, beginning with the bullish bets. Look at this, the Qs. Somebody's betting on a rebound here because NVIDIA is coming back, and maybe the sentiment will maybe become a little bit more favorable to the big caps. Despite the spending, I disagree, but this is what they're betting on. They bought the 550 calls, the expiration date April 17th, 2025, spending about $6.25 million. And then we have Humana, HUM. Somebody bought the 300 calls and the 270 calls for the expiration date, May 16, 2025, spending about $3 million. Name been suffering for a while now, but could be an opportunity. I don't know. I need to do my homework here to come to a conclusion to what they're seeing. Then we see the other one here, Procter & Gamble. This is a really interesting trade because it bets on lower dollar, lower bond yields. We're not seeing that yet, but it's still a solid name. If you looked at the earnings, it's still a solid name. And here they bought the 180 calls. Now, mind you, the stock is trading about 168, so they're betting on a big upside coming here for PG. The expiration date is June 20, 2025, spending about $1.1 million. Let's do the bearish trades, beginning with GLD. Look, gold is hot, got it. But is it a little more excessive to the point where if you've made profits, it is time to book some profits? Is it time to maybe hedge a little bit? Yes, it is. And I think this is what they're doing right now. They bought the 267 puts for the expiration date March 21st, 2025, spending about $1.2 million. And then we have Coinbase. This time around, they're buying puts. You saw that $100 million buying calls. We'll see what happens with the earnings. But here somebody bought the 280 puts for the expiration date February 14th, this Friday, paying about a little over $1.5 million. And then we have ARM. Here the trader bought the 155 puts. The stock's trading at about 161, 160. So not a huge drop here, just a little bit of a trimming, a pullback. So we see 155 puts for April 17th, 2025, spending about a little over $1 million. And then we got the IWM. Every time it goes higher, somebody says, forget about it, it's going down. They bought the 225 puts, and they sold the 175 puts for the expiration date of March 20, 2026, spending about $4 million. Of course, the IWM will go down if we have a hotter CPI, because that's going to cause rates to go higher. And lastly, NVIDIA been hot in the short run, at least buying the dip based on the assumption that the DeepSeek narrative has been reversed. But is it a little too hot in the short run that we can get a pullback? The answer is yes. And this is what the trader is betting on. They bought the 133 puts, the expiration date this Friday, the 14th, spending about $300,000. This is a reasonable bet because you're betting really close to the money with the expiration date of Friday. The name is a little hot. We might see some CPI hedging tomorrow. And if the VIX goes higher, it dumps NVIDIA by default. Let's do the charts analysis. We begin with the SPY. We'll do the VIX in a minute, but let's do the SPY to show you something here. And then we're going to confirm with the VIX. What we see is right now, perhaps, you can make a bullish argument, by the way, that we have sort of a falling wedge. The result was a breakout, and that we're forming sort of a bull flag, and we're ready to go higher. That is valid. That is, of course, also valid in the momentum indicators. The RSI is not overbought. The bearish argument remains that you went down, came back up in the grand scheme of things. In a B leg, you're going to come back in a C leg and form a lower low. Why is that important? To have both scenarios. It's important because in tomorrow's session, you want to watch 603. If we begin to trade below 603, then which scenario is more probable? Is it the bull flag scenario where we go higher? Or is it the inverse ABC scenario when you cut below 603? Right, 603 is going to increase the risk that it's going to be an inverse ABC. Then your confirmation is taking 600. At that point, you got to make the bet right away and go to 595. Of course, don't use the zero DTEs. Be a little more reasonable here. So first layer of confirmation to go with the puts, 603. 600, and then 595. And we'll see what happens because at that point, the hourly would be oversold. Now, let's contrast this with the hourly chart of the VIX. This is why I wanted to show you the SPY first, and then let's do the VIX. Because the VIX is showing a similar pattern, that this could be sort of a bull flag pattern, and higher we go. In other words, an actual ABC, right? So what is the important number in the SPY 603? The important number in the VIX is, again, I'm going to keep my number here, 1667. You can roll it down to 16.5 if you'd like, but I'll get about a tick higher, 67, just to be conservative, that once I get the confirmation, it ain't going to reverse right in my face and eat a pie right away. So I have 2 layers of confirmation tomorrow. 603 in the SPY, and then I got 1667. If both of them are working out, SPY below 603, VIX at 1667 and above, you put 2 and 2 together, you're going to make a bet. Looking at the 2 hours chart for the VIX, again, you see the bull flag pattern. Any damage on the momentum here? No, we're still bullish on the VIX in the 2 hours. And the hour side, in my opinion, is just heating up and coiling for a move higher, which means that this bull flag will lead to a move higher in the VIX until proven otherwise. But right now, this is my base assumption. Looking at the E-mini futures for the S&P, what do we do here? I'm still having the same pattern of lower highs, which should lead to lower lows. Our confirmation in the daily is losing the 50 days moving average. Of course, ultimate confirmation is losing 6,000. Right now, the assumption is we rebounded, low volume, maybe less than feared kind of tariffs, so we see a reaction. But that's over now. We're going to have to digest the new data. We have to digest the new tariff news. And don't forget the CPI and the testimony by pound. So if the technicals are saying anything right now, they're still leaning bearish. You see it in the momentum indicators in the MACD, in the RSI, in the Vortex. So right now, the base case is, as it was here, that we're going to retouch the trend line. The base case is, sure, we can play this game of trying to recover, but unless there's a catalyst that causes the recovery higher, the base assumption should be that whatever consolidation we do here, we cut below the 50 and then form the lower low. Looking at the NASDAQ, the Qs, hourly chart, we can argue the same thing that we've done with the SPY, that this could be a falling wedge, got a breakout, now we're forming a bull flag pattern, higher we go, got it. When do we negate all of that? Losing 527. So if you lose that 527 line, probably the SPY is losing 543, probably Apple is down, probably NVDA is pulling back, and you see the Qs coming back down. And then we're going to have a risk if we look at the daily chart. We're doing the futures now. It looks a lot better, of course, in the SPY and the E-mini futures because the jump in NVIDIA. But all in all, it's still negative, or let's say lagging the S&P when we look at the daily chart. Because we have this gap that we closed, and the majority of the weakness came from the big caps, so the NASDAQ is underperforming the S&P. Now, when do we have confirmation that whatever attempt for a recovery here is met with failure? Losing the 50. You close below the 50, forget about it, we're heading down to 21,000. So once we lose the 50, I'm going to open the 21,000 and sell the 20,000 for March expiration. The big kahuna Apple, what do we see here? The assumption right now is confirmation of the bear flag. We couldn't really recover in Apple. The majority of the action that we've seen, the positive action that we've seen in the flow, came from NVIDIA, not from Apple. Now what happens? The momentum is rolling over in Apple. So the assumption is once we lose 225, we're heading down to the 200 days moving average. Let's call that at about 220. Usually you're going to pierce below a little bit, and then we might at least try to find a point of support as we've done here. And we see Apple rebounding, but if it fails again, you got to double down because we have lower targets to come in Apple. But one step at a time. Right now it's a bear flag with the target off 220, confirmation losing 225. And then we see a rebound, and after that we cut through and come back down if the narrative stays negative. What do we do with NVIDIA? Got a nice rebound here, reclaimed the 200, and of course it's all, you see that computerized volume right here? That's just the asset managers rotating back. That's what it's all about. And maybe they've done enough, maybe they haven't done enough, we'll see. But right now we got to the 100 days moving average. Nice gain right here. Think about the sellers who've been holding right here, and they went down. When they come back up, are they greedy enough to say, yeah, but I'll give it a shot. Maybe we'll go back and form higher highs. Maybe. But you got an earnings report coming right here. So at least some of these holders who've been stuck here for months, they're going to use this opportunity to say, you know what, I could have sold here, but now I can sell right here at the 130s. And we already had the 100 days moving average. So why not a pullback? And then let's see how we hold the 200. If we hold it, so far so good, higher we go. If not, then what's going to happen is we cut through the 200 again and head to lower targets. I don't think that's going to happen, to be honest with you, until the report is out. I think what's going to happen right now is NVIDIA just consolidating in this wider range until this report comes out, and then we see a breakup or a breakdown. Looking at the 30-year bond yield, which is the second indicator that we use, topping in a shoulder played out, but it didn't really break the important point right here, which is about, let's say, 566 basis points and around that number, because we found support right here before we went higher. Now the assumption is we have the 50 days moving average. Can we crack above or maintain this bear flag pattern and head down to retest the important level? Of course, what's going to dictate what's going to happen here is the CPI. If the CPI is hot, forget about it. The 30 is going to move higher, and that's going to be upsetting for the market. We're going to retest 4.8 again. CPI comes out lighter, you're going to see the bear flag coming back down. We retest the important level right here. How do we play the game in the Russell 2000? You're still in the RTY, the Russell futures. You're below the 50 in blue. You're below the 100 in red. And the assumption is if we continue to trade that way and we don't play sort of a bull flag pattern right here, depending on the CPI, of course, what's going to happen is momentum is going to turn negative in the MACD indicator. You guys see the RSI with negative divergence, and we're going to retest the 200 days moving average. So we've retested once, it held. Second time, third time is a charm. It's going to break below, folks. Looking at the XHB home builders, this is also dependent on the CPI. If it comes out hot, bond yields go higher. I think we break, and once we break that number, 104.17, let's call it 104 even to be conservative. But we will see a flush down in the XHB because this could be also a formation of a larger head and shoulder pattern. Once you break, you're going to head down again with the same, let's say, gain here that was on the upside from the shoulder to the head. You'll see that to the downside. At that point, of course, you're playing the weekly chart. And if you are playing the weekly chart, what are you going to see here? Inverse ABC to the 100. That's, of course, CPI got to come out hot. Anything changed in the KRE regional banks? Not really. A little bit of weakness today because the banks sold off. But we haven't eliminated the cup and handle pattern. We haven't eliminated the 50 days moving average. We don't have a confirmation in the MACD of the momentum changing from bullish to bearish. I think that's going to happen once we lose the 50. Not saying that the case right now is higher we go. There's a really solid case that we flip to negative and we see the KRE trending down. But right now, the risk is if you enter before the confirmation of losing the 50. This could be just a pullback and ABC breakout. So be careful here. Lose the 50, close below the 50, and then grab some puts in the KRE. Looking at the defensive side of yield sensitive, IYR still holding. So the IYR may be holding a bull flag pattern above the 50 and ready to break out. Problem is if bond yields rebound after the CPI, the defensive and the risk on, say the IWM, the XHB, and the IYR, will head down together. But I would say if I see a tame reading in the CPI and yields go down, I'd rather go with the chart that behaved better, which is the IYR, the defensive side, not the risk-on side, which has been weak in the XHB and the IWM. Another yield-sensitive defensive, the XLP, looking pretty good right now. Maybe we can see sort of a Christopher Nolan pattern of inverse and a shoulder within an inverse and a shoulder. Of course, we're above the 50, but we have this breakdown candle. The top was 80.17. You break above, you close above. That's your confirmation that the XLP is heading higher. The third indicator, of course, is the dollar. And right now, the assumption is we could still play the bear flag pattern. A little bit of a rebound of the dollar, but then depending on what Powell says, depending on how the CPI comes out, we might see a drop down. And if that is the case, then gold, silver, all of the commodities go higher. But my 2 cents say the Tricky Dixie plays weak and then it goes higher. If I'm looking at the MACD indicator right here, it is trying to coil its way higher. So you got to be careful here of being sucked into the candlestick pattern of saying this is a topping candle, bear flag, down we go, because momentum might shift to positive first. We might see a pop in the dollar, such as retesting the highs before we come back down. If that is the case, the old man gold futures looking pretty good. Hot, hot, hot. But as I said, if you're long GLD, long GDX, long the futures, long physical gold, what you want to do this week, because we have a lot of data coming out. We have CPI, PPI, we have Powell testimony. We have the threat of tariffs. We have stimulus in China, which is pretty good for gold, by the way. But to be in the safe side, why don't we buy just weekly puts in the GDX or the SLV? Just a small position that if we go down in the main position in gold futures or GLD, at least we're being compensated, and then we can think. Do we just buy the dip or do we exit? Because you need a process of thinking based on what the dollar is going to do. So right now, so far, so good for gold, but it is time to hedge because you see the reading in the RSI, it's a little bit excessive. Now, pay attention to the chart of copper futures because copper futures right now with the tariffs and China stimulus, look at what's happening right here. You have the double bottom. You have momentum shifting back to bullish. We're breaking above, if we do the adjustment right here, we're breaking above a sloping line of resistance. All of this is positive, and it leads me to retest this level right here before we pull back. So copper might head all the way to 4.86 before it finds resistance. And that's, of course, going to be good for copper stocks, but also inflationary. Looking at other dollar-sensitive assets like the agricultural names, also nat gas sensitive like MOS, fertilizers. You see the drop that we got on Friday, not justified in my opinion, and we see now a little bit of a rebound. Not out of the woods yet, but we're still maintaining an inverse in his shoulder, so keep an eye on those. If we crack above 28.5, we'll close above, then this chart is heading much, much higher. So keep an eye on it. What happens now with crude oil? It found support where we're supposed to find support, but you got to remember, you got to close above the top of this candle right here, which is 73. We haven't done that yet. And then better, you have to close above these 75 levels. So one step at a time, 73 closing above leads us to 75, closing above 75. All of this energy right here will be released to the upside in a big way. So USO right now looks a lot better if you want to trade versus the XLE. When you see all of this energy right here being released in USO, and I think we're probably going to close the gap here, if not challenge the highs, because China's stimulus news, believe it or not, is more impactful to the price of oil than anything you can get from the supply side or the dollar. The souffle daily chart, what do we do here? I mean, look, the risk of Elon turning into Kanye in any moment right now is highly likely, and the numbers are not looking pretty good for the company. I mean, deliveries are awful across the board. This is just a stampede by the stupid cult, and it led the stock to becoming overvalued again. It has to come down back to rational valuation. Right now, as we said in last night's program, at the point where we hit the 100 days moving average in or around that number, it doesn't have to be exact. You have a gap right here that we're going to fill, and the 100 at the same time. And the hour sign of the daily is going to be severely oversold. So that's going to be a point where you want to close your puts. If we get to 340 tomorrow, 335, I would close the puts, or at least roll if you still think that Tesla's going to go down. Maybe hedge via buying a rebound play for Friday. We'll talk about all of this, of course, in Discord. Any notable update that we see in Bitcoin? Not really. It's the same conversation and discussion that we talked about in last night's video, so we're not going to waste your time here by talking more about it. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? We got the NFIB Optimism Index. That's important to the health of the economy, unless there's an outlier. It's not a market mover, though. Then we have a bunch of Fed zombies talking. The most important one is the big zombie himself, Jay Powell. He's going to be testifying in Congress. That's going to be 10 a.m. Eastern time. So we got to listen to Mr. Powell, see what he says, and of course, the questions and the pressure that he's going to get. Reinflation and tariffs, that's going to be telling for the market. And of course, the market is sniffing for what? The market is sniffing if Jay Powell is going to pause longer or he's open to hiking rates. That's going to be problematic. Then we look at the earnings calendar. What do we got tomorrow? We got in the morning, we have Coca-Cola, we have Shopify, important names. We have Marriott, also important indicator for the economy. We have Carrier, also important indicator for the data center build-up. And then we have after the bell, we get names like Gilead. We get names like DoorDash, all important names. Energy transfer, of course, comes after the bell. We just talked about that in the beginning of the video. With that, folks, stay tuned here. We got more content coming out for you. But this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Well, what goes up must come down, and down, and down.
I don't know what the hell you want from me.